Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know, first, US inflation hits 3%, but the softer than expected print fuels Wall Street bets on an imminent Fed rate cut. So we'll discuss why this 3% figure is seen as a sigh relief for the Fed and what it means for future interest rate decisions. Second, 20-plus nations vow to block Russian energy, but the debate over seizing 140 billion euros in frozen assets risks global financial stability. We'll examine how seizing these assets could shatter sovereign immunity and what it means for the US dollar's global dominance. Third, US-Canada trade talks collapse over a political ad featuring Ronald Reagan, linking the dispute to a pivotal Supreme Court case. Today, we'll take a closer look at this battle over Reagan's legacy and its implications for US presidential tariff power. Let's start with a single statistic that has Wall Street buzzing. The US government just dropped its first major economic report since the shutdown, and inflation has hit 3% for the first time since January. But to get the full picture, you have to look beyond that headline number. You see, not all inflation is created equal. Economists track two numbers: headline inflation, which is that 3% figure, and core inflation, which strips out volatile food and energy prices. That distinction is the key to the whole puzzle, because while headline inflation is up, driven by things like gasoline, many economists believe the underlying or core trend is actually weakening. A while back, we analysed why that underlying trend might cool. Market rents were already rolling over, and as we noted then, that tends to lead the official data. What's really driving the market reaction, though, isn't the number itself. It's the fact that analysts got it wrong. They predicted a 3.1% jump fueled by new trade tariffs, and that slight miss is now bolstering bets that the Federal Reserve is about to cut interest rates again. We previously highlighted that while tariffs bite in certain categories, broader price pressures were already easing beneath the surface as rents cooled, so the surprise isn't coming out of nowhere. And this isn't just an abstract number. It's hitting your wallet directly. Prices for beef and veal are up over 14% since last year. Coffee prices have surged nearly 19% in the same period. Even furniture, heavily impacted by tariffs, is up 3.8%. So the thing is, while the overall impact of tariffs on inflation has been muted so far, certain import-heavy categories are feeling the full force. This is a sign that the US-China supply chain is under stress. For companies that rely heavily on Chinese imports, it's becoming harder to absorb these extra costs, so they are passing them on to you, the consumer. This creates a split in the market where you see sharp price hikes on some specific Chinese-made goods, even if overall inflation isn't skyrocketing. We said a while back this split would show up most clearly in categories like furniture, even as other parts of the basket softened. This is why the Social Security Administration just announced it's increasing payments by 2.8% next year to keep up with the rising cost of living. For many, however, there's a tough reality baked into these numbers. That 2.8% adjustment is based on inflation data from several months ago. With current inflation running at 3%, this increase actually amounts to a real income cut for millions of retirees. Their benefits just aren't keeping pace with the actual cost of living they face today. It's a classic problem with backward-looking adjustments, and it could dampen consumer spending from a very important part of the population. As we discussed earlier, because CPI shelter includes both new and existing leases, it moves slowly, which means cost of living adjustments can lag what renters are actually seeing in real time. This is where the situation takes a more complex turn for the Fed. It's caught in a bind, hiring is slowing, which signals a need to cut rates, but prices are rising faster than their 2% target. Here's where it gets interesting. The secret weapon here is something called shelter inflation, which is basically the cost of housing. It's the single biggest component of the inflation index, making up about a third of the calculation. A while back, we flagged the cooling in market rents as the leading indicator to watch, driven by a flood of new multifamily supply, especially in Sunbelt cities like Dallas, that pushed vacancies to record highs and knocked apartment rents lower. Because CPI shelter folds in both new and existing leases, we said there's a lag before that cooling shows up in the official data. Continuing that discussion, this crucial component is finally starting to slow down significantly. Because rent agreements take time to adjust, there's a well-known lag of roughly 6 to 12 months. So the slowdown we're just starting to see reflects a cooling rental market from earlier this year. This single factor could be powerful enough to pull overall inflation back down toward the Fed's target. giving them the green light to cut rates. It also helps explain the split we noted before. Apartment rents easing while single-family rents, though slowing, remain firmer, a two-tier market that feeds right into this mixed inflation picture. According to Olu Sonola at Fitch Ratings, the Fed will feel a sigh of relief with these figures because the tariff impact seems muted for now. He says, as odd as it may seem, the Fed will be happy with inflation around 3% for the next couple of months. He says this because many investors believe the Fed's priorities have shifted, at least for now. They seem to be showing what economists call an asymmetric tolerance for inflation. This means they are more willing to risk inflation running a bit high for a while in order to prioritise their other goal, supporting economic growth and employment. It's a high-stakes bet. If they're right, they can guide the economy to a soft landing. But if they're wrong, they could be forced into a sudden policy reversal later. Analysts at Wells Fargo go even further, saying the softer-than-expected numbers all but guarantee a rate cut, but they add a major warning. This data is not so soft that the committee can sound the all clear. A slowing economy and persistent price hikes are forcing the Federal Reserve into a corner, making the next interest rate decision one of the most critical this year. And as we've been tracking, the next big tell is the official CPI shelter prints. In the months ahead, if the rental cooldown keeps flowing through, it opens the door wider for easing. If not, the fight drags on. We were just talking about the Fed's tightrope walk with inflation here at home, but on the global stage, economic pressures are being used as a weapon in a very different kind of fight. More than 20 nations have just made a stunning pledge to take Russian oil and gas entirely off the global market. In a summit in London, Ukraine's allies declared a new phase of economic warfare. The UK Prime Minister stated bluntly, "We're choking off funding for Russia's war machine. This isn't just talk." The UK and US have already sanctioned Russia's two biggest oil companies, and the EU is now targeting Moscow's lucrative liquefied natural gas exports. A while back, we walked through Washington's direct hit on Rosneft and Lukoil and how markets slapped on a quick fear premium. The difference now is that allies are trying to convert that one-off shock into a coordinated squeeze. The immediate question, of course, is what this does to prices for everyone else. Interestingly enough, other oil-producing countries are stepping up. The International Energy Agency projects that in the coming year, global oil production will rise significantly. And almost all of that new supply, nearly 90%, is expected to come from countries outside of the traditional OPEC Plus alliance. We're talking about the United States, Brazil, Canada, and others. This increase is meant to act as a buffer, helping to stabilise prices. As we noted before, though, that buffer only holds if enforcement bites. Otherwise, the sanctioned oil still finds a way to market. However, if you zoom out, you'll see another layer to this strategy that shows its limits. We're seeing a two-tiered global energy market emerge. While the West is sanctioning Russia, Moscow has been successfully redirecting its discounted crude oil to other major buyers, primarily China and India. For example, India has become one of Russia's top customers. This trend undermines the sanctions' full impact and shifts a degree of economic leverage to these non-aligned powers. We previously tracked how a shadow fleet keeps these flows alive. The one lever that could really close that back door is secondary sanctions on those facilitating the trade, but that would risk a broader confrontation with Beijing. What really brought this to a head was the next development. The military support Ukraine urgently requested is missing. No long-range missiles were announced, the very weapons President Zelensky says are needed to make the war costs heavier for Moscow. This continues what we discussed a while back about the tense Zelensky-Trump exchange and the refusal to greenlight Tomahawks. The denial of these specific weapons isn't just about avoiding military escalation. There's a crucial economic logic at play. These long-range missiles would allow Ukraine to systematically target and degrade Russia's oil refineries. Recent drone strikes have already shown how effective this can be, causing Russian diesel exports to drop by about 20%. By holding back these weapons, Western allies are essentially trying to damage Russia's war funding without triggering a massive global energy price spike that would hurt their own economies. This follows recent talks where Donald Trump indicated he was not ready to supply Tomahawks. The stakes couldn't be higher, with President Putin warning that if such weapons strike Russian territory, the response will be overwhelming. We previously reported claims that he threatened to destroy Ukraine if it did not comply, so the rhetoric and the risks have only intensified. Now, if that was just the appetizer, the main course is just being served. Believe it or not, there is a staggering 140 billion euros in frozen Russian assets on the table. EU leaders are now debating using that cash to finance Ukraine's defense, with a decision on a so-called reparations loan possibly coming by Christmas. Remember, we also talked about the looming reconstruction bill over $500 billion. So unlocking these funds isn't just a wartime play, it's a bridge to rebuilding. This move would set a massive precedent in international finance. Normally, a country's assets held abroad are protected by sovereign immunity. Seizing them could fundamentally change how countries view the safety of their foreign reserves, encouraging nations like China to speed up their efforts to de-dollarize and reduce their reliance on US government bonds. This would alter risk calculations for every country in the world. For markets, this sits alongside the question we raised earlier about higher for longer defense outlays and order backlogs. This high-stakes financial maneuvering is happening while President Zelensky warns that Russia wants to make the winter cold a tool of torment for civilians. The Allies have launched an all-out economic assault, but the central conflict remains: a strategy of financial strangulation against a brutal reality on the ground. The latest data from the Kiel Institute's Ukraine support tracker actually confirms this trend, showing a recent sharp decline in pledged military aid, even as financial aid has remained stable. Speaking of high-stakes international manoeuvring, a political dispute closer to home has just derailed the entire trade relationship between the US and Canada. All trade negotiations have been abruptly terminated, and the reason isn't a dispute over lumber or dairy. It's a political ad featuring the voice of former President Ronald Reagan. Now, this isn't a minor disagreement. The US and Canadian economies are deeply intertwined, especially under the USMCA. Think about the auto industry, where parts cross the border multiple times before a car is finished. This kind of sudden, politically driven halt creates extreme volatility and disrupts supply chain planning for countless businesses. It adds a major risk premium for any company reliant on stable cross-border trade. The government of Ontario released a video criticising US tariffs using audio from a 1987 Reagan speech. In it, Reagan's voice warns, high tariffs inevitably lead to retaliation by foreign countries and the triggering of fierce trade wars. Then the worst happens. Markets shrink and collapse, businesses and industries shut down, and millions of people lose their jobs. And Reagan wasn't just speaking in hypotheticals. The ghost of the 1930 Smoot-Hawley Tariff Act looms large in economic history. That act raised tariffs on thousands of goods to protect US industries, but it backfired spectacularly. Over 25 countries retaliated. Global trade plummeted by an estimated 66%, and many economists believe it significantly worsened the Great Depression. This is the worst happen scenario that free trade advocates always fear. The reaction was immediate and explosive. President Donald Trump announced the halt to all talks on Truth Social, accusing Canada of trying to interfere with the decision of the US Supreme Court on a major pending tariff case. This decision brings both economic risks and comes with inherent political drama. The Supreme Court is reviewing a pivotal case that could redefine the scope of a president's power to impose tariffs without explicit approval from Congress. A ruling that upholds broad presidential authority could trigger a sharp drop in stock prices for import-sensitive sectors. Conversely, a ruling that limits that power could unwind the entire foundation of the current US trade posture. President Trump's comment explicitly links this Canadian ad to that high-stakes legal battle. The Ronald Reagan Presidential Foundation quickly backed this up, but that's not the whole picture. The real turning point is that critics are now firing back at the foundation itself. Dartmouth economics professor Paul Novosad called the foundation's statement an incredible cynicism and betrayal of Reagan, arguing that the ad accurately reflects the former president's message. This has ignited a war over Reagan's own words. The Canadian ad uses direct quotes where Reagan warns that protectionism hurts American workers and consumers. Yet the full speech shows Reagan was imposing tariffs on Japan at the time, framing it as a reluctant exception to his firm belief in free trade. When we place Reagan's actions in the 80s alongside the broad tariffs we see today, the contradiction becomes clear. His tariffs were targeted temporary measures to enforce a specific trade agreement Japan was seen as violating. It was a tactical move, not a fundamental shift in philosophy. By comparison, today's broad-based tariffs are more about a strategic, long-term national security competition. This distinction is at the very heart of the fight over who gets to claim Reagan's legacy. This isn't just a political squabble, it's a battle over the economic philosophy of a conservative icon with the trade relationship between two of the world's closest allies hanging in the balance. The central conflict now revolves around a single question: who truly represents the legacy of Ronald Reagan? So, what should we be watching for next? The most immediate focal point is the Supreme Court's decision on presidential tariff authority. That ruling will be a major market event. In the meantime, keep an eye on the exchange rate between the Canadian and US dollars. A weakening Canadian dollar could signal investor anxiety. Ultimately, this episode shows that political rhetoric itself has become a key variable that investors must now track to price the risk of sudden trade escalations.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.